Okay, I'm going to get into a little bit more detail on the RSP and derivative account. What are the derivative accounts? The derivative accounts are the RIF account, a company pension is a derivative account, a LIF, a LIRA, there's a few others. They all follow the same tax rules and they all are designed for the same purpose. So what is the purpose of the RSP and all the derivative accounts? The government wants you to save for your retirement. So what do? They provide incentives for you to save for your retirement. Now the feature of the RSP account and all the derivative accounts are the incentives. Now I'm going to reduce my face. So that's it. Now the reason that I point that out, it is important. Too many people these days think the RSP account and all their derivative accounts are government scams designed to extract more tax from you. This is wrong. If you take nothing else away from this video, just remember that the purpose of the RSP and derivative accounts and the RSP RIF process is to provide incentive for you to save for your retirement. And the incentives, I'm going to go through the incentives shortly here, but the incentives are beneficial. Now the whole idea behind the RSP and RIF combination is you make contributions in the high income years. This reduces your taxable income and therefore saves you tax in the high income years. And unfortunately, when you redeem from what is likely a RIF in the retirement years, likely the low income years, this adds to your taxable income. So you reduce taxable income in the high income years and you add to taxable income in the low income years. We live in a progressive tax environment. It is beneficial to reduce taxable income in the high income years, and this offsets the tax burden in the low income tax years. So I'm going to talk about the benefits. There are two benefits to the RSP and derivative accounts, so even the RIF account. Now, contributions reduce taxable income at the time of the contribution. Now, you can't contribute to a RIF, so we're talking about the RSP only here. The RSP and non-RIF derivatives, a company pension, for instance. This is a big benefit, and I'll go through this in a second. Now, the second benefit is also a big benefit, and it is the same benefit that happens in the tax-free savings account. But the benefit is this: everything that happens within the account is a non-taxable event. So, let's say I have a GIC in an RSP account. It pays me interest every year. Let's say I get $1,000 of interest income. I do not owe any tax immediately on that $1,000. It adds to my balance. It compounds over the years. This is a big benefit. Now think of a capital gain. I'll use the example of a magical stock. I buy a stock for $10,000 and it goes up 10 times, so it's now worth $100,000. I sell it within an RSP account. There is no immediate tax consequence. Now my RSP is $90,000 more valuable because of the capital gain, and this eventually gets extracted when I'm retired and pulling money out. But the selling of the investment does not trigger a capital gain and therefore capital gains tax. It would in a non-registered account. So those are the two benefits. Contributions reduce taxable income at the time of contribution, and everything that happens within the account is a non-taxable event at the moment it happens. Now the one supposed detriment is money leaving the account is added to taxable income and therefore adds to the tax bill. So again, if I'm retired and I've got $20,000 of CPP and OAS and another $10,000 in pension, my taxable income is $30,000. If I redeem $5,000 from my RSP or my RIF account, my taxable income rises from 30 to 35. So that is the one supposed detriment. And I'm going to say why it's supposed. I mean, it would be nice if it was tax-free completely, but look, it's not, but the account is still beneficial. Another thing to note is that anything coming out of the RSP or the RIF account is just ordinary income, whether that was generated from interest, a dividend from a Canadian company, or a capital gain. It doesn't matter. Preferential tax rates are irrelevant in the RSP account and the RIF combination. Now, it's important to note that money in an RSP account is money that you have not paid tax on. Let's say you work, you make $80,000, your company remits to the government based on your $80,000 correctly over the year. You make a $5,000 RSP contribution. The government is saying, hey, here's the tax that we received on that $5,000. We're giving it back to you because you made the $5,000 RSP contribution. Okay, so I'm going to run through an example here. Taxable income. Here's the example. Taxable income while working, $80,000. Taxable income while retired, $35,000. I make an RSP contribution while I'm working, so my taxable income is $80,000. I make the contribution. That knocks my taxable income down to $75,000. I won't go to the calculator, but that $5,000 RSP contribution resulted in me saving $1,531 in tax. Okay, so this is the scenario. So my taxable income while retired is $35,000 plus the $5,000 RIF withdrawal. Okay, so how do we think about this? I'm going to show you two ways. Let's say I made my very first RSP contribution the year before I retired. I then retire and I take out the $5,000. Okay, so I save $1,500 on the way in. My income falls to $35,000. I redeem my $5,000 RSP account. We'll say that the account hasn't grown, but I didn't have an account. I make a $5,000 RSP contribution. I have an account. I retire the end of that year, and then the next year I take out that $5,000. Well, I saved $1,500 on the way in, and here's my income in retirement, $35,000 plus the $5,000 RIF withdrawal. I pay $1,003 on the way out. I am ahead by $528 without any growth. There's no growth. That's I've saved $528 on tax. I saved $1,531 on the way in, and I paid $1,003 on the way out. Okay, the better way to look at it is this. Let's say I make an RSP contribution 30 years ago, and I'm now retired. What is happening here? Basically, I have turned, that RSP contribution has turned nothing into a $1,531 tax benefit. This is money I get back. So if I don't make this RSP contribution, I don't get the $1,531. You know, think of it as, let's say the company remitted correctly. I get a check back for $1,531. I don't get that check if I don't make the RSP contribution. And when I retire and redeem the $5,000, I pay $1,003. Think of it this way. I go to my bank. I say, Mr. Bank Manager, I'm here to negotiate a loan, and here's my terms. I want a long-term, a 30 or 40-year term loan where I pay 0% interest, and when it's time to pay the loan back, I only roughly have to pay back 2/3 of the loan. That is what is happening here. The government is giving you a long-term interest-free loan, and when it comes time to pay back the principal, I only have to pay back 2/3. Okay, I made $80,000. 30 years ago. I made the $5,000 RSP contribution 30 years ago. It accumulated. It grew and grew and grew. I take out the $5,000 when I'm retired and my income is only $35,000. The $5,000 RRSP withdrawal increases my taxable income to $40,000. That $5,000 withdrawal boosted my tax in retirement by $1,003. I got an interest-free loan. It did what it did. It sat in my RSP account. It grew, it grew, it grew. I redeem. I therefore pay back the loan to the government, and I only have to pay back 2/3. That is what is happening in an RSP account. As long as your taxable income while working is higher than your taxable income while retired, and that is the case for the vast majority of Canadians. So, a few things about the RSP RRSP combo. The general design is to accumulate into an RSP and withdraw from a RRSP, but withdrawals from RSPs are allowed. You cannot contribute into a RRSP. RSPs must be converted to a RRSP by the age of 71, and you must withdraw at least the government mandated minimum per year. Now, don't forget that money in the RSP or the RRSP, no tax has been paid on that money yet. Now, the government's saying, hey, we've given you a very big tax break, but we do want some tax on this money that is in your RSP or is in your RRSP. So eventually we're going to force you to withdraw from the RRSP. You can name a beneficiary on the RSP and RRSP and all of the derivative accounts. This is beneficial because naming a beneficiary takes precedence over the will, so this money avoids the whole probate process. And there better be a darn good reason that you don't name your spouse as a beneficiary, because death triggers a deemed withdrawal and all the money is included in taxable income on your final tax return. So if I have $200,000 in my RRSP account and I don't have a spouse, my income in the year that I pass away is at least $200,000. This takes a little bit of planning. However, if I have a spouse, this transfers, it's a non-taxable event. It transfers to my spouse. And however, when she passes away, it can't get transferred to anybody else as a non-taxable event. When she passes away, it's brought into income. But hopefully it's kind of dwindled down. Hopefully it's not $200,000 anymore. It's substantially lower. So here's the planning on this. Let's say I don't have a spouse and my doctor comes to me and says that, hey, Rob, bad news. You only have 3 years to live. It is much more tax efficient for me to redeem my account roughly 1/3 per year for the next 3 years instead of redeeming all of it on year 3. Okay, so that's the basics of the RSP account. And what is important here is that you understand that the motivation behind the RSP account is to provide incentives to save for retirement, and the incentives are beneficial. Now, the RSP gets, and the RRSP combination, especially with retirees, gets a bad name because they may have retirees. What they notice when they make a RRSP withdrawal is it adds to taxable income and boosts their tax bill. They get annoyed by this. Now, I don't blame them for this because they likely have forgotten the benefit of making the contribution because the contribution could have been made 30 years ago. So there's tax gain and there's tax pain here. The tax gain occurs at the time of the contribution, and the tax gain is the tax-free compounding in the account, and the tax pain happens when you make the withdrawal out of what is likely a RRSP account at this point. But the tax gain substantially overwhelms the tax pain. But by this point, the retirees forget about the tax gain. But you can't forget about the tax gain. It's like an interest-free loan, and you can let that money grow, and then eventually you have to pay a little bit of tax on it. I hope that helps, and onward and upward.